If you typically get pledges or committed funding for your organization, if you're often finding out or thinking to yourself, how do I handle accounts receivable? Is accounts receivable and pledges receivable the same thing? Then you want to stick around for this video because we're going to be talking about how to handle pledge receivables in QuickBooks Online. So let's jump into today's video. All right, guys, so as you can see, I am back, and I am back with handy dandy notebook / laptop. We're going to be talking about how to handle pledge receivables in QuickBooks Online. And so let's talk about it. So often I'm asked like promises to pay, committed funding, pledges, AR, like, are they the same? And so I'm going to dive into pledge receivables, and in the midst of that, I'll answer that question. So if you often receive pledges or promises to pay, rather a financial support, typically they're captured on the balance sheet. Now there's a lot of ruffling or discussion as to when do you actually put it on the balance sheet? Is it when the person makes the promise to pay? Is it when you receive the agreement because you are more so 99% certain that it's actually been committed and will be paid out? Every organization kind of operates a little differently with that and have like a way that they determine, whether or not a pledge is actually committed versus you just got a verbal promise to pay and it's like, I don't know if I'm really gonna receive that money. You might be thinking, okay, that's what I use grants receivable for. And you're not necessarily wrong. What it is that a lot of these terms are being used interchangeably and they often mean the same thing and can overlap, right? And so, a gift to the org for most people means like anytime someone is giving funding, right? If it's a grantor and they're telling you that, this is a multi-year grant, you have an agreement, right? We know that typically we will use like grants receivable account. If it is where you got a promise to pay from an individual or foundation and you're pretty certain they're gonna pay out, some use pledge receivables for that, right? Then we have those grants where it's like, I have to spend first, it's reimbursable, I have to spend first, and then I have to invoice them in order to get paid. And so some say, that's accounts receivable. All correct, not wrong, right? Whether you use both accounts is up to your organization. I'm specifically gonna be talking about pledges receivable. However, just know that some of these things can overlap with some of the other AR type accounts. So the next thing I wanna discuss, which I kind of touched on, is that at what point do you know that the commitment is actually real so that you can account for it? So what you wanna do, one is you wanna consider a few things. One, was the channel formal? Did you get an agreement? Did you get some sort of a letter, something that you can actually refer to, like some documentation, right? Were you given an exact amount? So not, oh yeah, I wanna, give your organization some money. What is some money? We don't know what that is. And so for that, it's like, But if it has documentation, it's like, we are granting X organization $50,000 to be paid out by this date, we that's real, right? We know that we can refer back to something, right? It wasn't just a passing conversation. You want to think about whether or not the donor or the funder gave you certainty that they would pay out. This can include things like a fixed payment schedule. It can include words such as pledge, binding, agree. The amount of the promise can be determined. That's the key, because number one, you can't put anything on your balance sheet if you don't know how much, right? And so if it's just a random promise and there's no amount, what are we even talking about here? Kind of like I mentioned before, most organizations have some sort of like percentage scale that they use. So for example, if they're 75% sure that the funds are going to be received, at that point, they'll go ahead and account for it on the balance sheet. But if they're less than 75% sure, they might say, we're not sure, so we're not even going to put it on there, and then have to go through the whole process of writing it off and things of that nature. So that also is something to consider. It might be worth it to ask yourself, should we wait for further confirmation? Let's dive deeper into pledges. Pledges typically can be either conditional or unconditional. If it's unconditional, right, that means that it's typically legally binding. However, it's for a specific amount, regardless of any contingencies. These are typically recorded as revenue in the period when the pledge is received. So not necessarily when the money is received, when the pledge is received. On the other hand, you have conditional pledges, which are contingent upon fulfilling a certain thing. So you can honestly think about it in a way of, if an organization may say to you, say, I'm giving you $50,000 for this parking lot project, right? But you have to complete milestone 1 before you get $25,000. And then once you wrap up the project, you get the other $25,000, right? So it's contingent upon the fulfillment of certain criteria. by the nonprofit, right? So it might be reaching a specific fundraising goal in order for us to match those funds, right? Or completing a specific project phase, like I just mentioned. Those conditional type pledges, now those are not recognized as revenue until you've actually met the condition. So until you've actually met the fundraising goal, or until you've actually completed that said phase of the project. Now, there are some common challenges as it relates to pledges, and that's things like, when do you record it? When do you recognize it as revenue? Understanding how to account for what's restricted versus unrestricted. And so one of the things that I implore you to do is to avoid prematurely recording as revenue. Be sure. And when I say be sure, that's why you need to refer to the documentation. Be very clear on whether this is conditional or not. And that's why these type of conversations shouldn't really happen in silo, right? And so typically I find that like your head of fiscal, your head of development, even like your ED are coming to the table, having discussions, talking through these grants that before you even get them, like when you apply for them. So like, let's talk about what's going to be required of us so that we even know if this is something that we can do, if these are conditions that we can even meet, right? So that when the fund is received, we're recognizing it appropriately, right? We're recording it as revenue when we should. If there are conditions, we're meeting the conditions, we're tracking meeting those conditions, and we're not just like looking for a money grab, because a lot of times it's like, I need the money, I need the money, I need the money, but we're not thinking about the requirements and all of the compliance pieces that come with getting this money. I want to go a little bit deeper into conditional pledges. With unconditional, there are technically no stipulations, right, that have to be met for you to receive that funding, and so it's a bit easier to manage. I want to talk a little bit more about conditional pledges, because that typically is where the rocky boat comes into. So if it is determined that a grant is conditional based on certain criteria, right, that means that there should be no financial statement recognition of said grant until the conditions are met. We shouldn't see it put on the balance sheet until you've at least met the criteria, whether it's multiple milestones, completion of a certain phase. The one exception to this, which happens quite often, is when an organization is advanced the funds. I'm sure many of you, if you have received grant funding, you know about getting advances. This is something that was so common when I worked at a big nonprofit here. They were in contract with multiple different government agencies, and these government agencies were known to send advances all the time. So it was such a thing. If you are advanced the funds, that is the one caveat. In that circumstance, right, you're going to record it as a refundable advance. So it's going to technically be considered a liability because you did not earn it yet. And so you don't want to go happy-go-lucky and start recording it as revenue. It technically is going to be a liability on the financial statement still until all the conditions are met. And once you do that, then it will be recognized as revenue. And after the full value of the payment has been earned, that's when you'll do that journal entry. I was about to tell you the journal entry, but I don't want to get into much accounting jargon because I don't want to start losing you. Because again, as you can see, this can get tricky. The best way to track these sort of pledges is to have an agreement with your donor or your funder so that you are sure about the conditions or not, because that's going to detail how you are to account for the pledge on your books, right? Don't forget that. If you don't have an agreement, if you don't have documentation, then I implore you to maybe take a step back and not consider those funds committed just yet, and to wait till you have something that you can actually refer to so that there's some certainty that these funds are going to be received. All in all, there's a good amount of work that has to be done before you even touch or get into QuickBooks Online to say, does this belong on a balance sheet? Where should this be recorded? You need to map out the specifics, make sure you understand it, then move forward with recording the receivable or whatever it is that you have to do. Because if it's an advance, it's a liability, right? Before you even move forward, what you need to do as far as putting it on the books, just map out those specifics and make sure you truly, truly understand. Managing the books of a nonprofit can be very complex. And sometimes it's not helpful that there are always like new regulations coming down from the state or the federal government. And so it is very important to keep your ear to the ground. This is why we have created the Accounting for Good community. It is so that we can share these trends with you, these new regulations, this information with you, right? And so that you can also be in a community of your peers, because someone may be asking a question that you didn't even think about, but it applies to you or it applies to your organization. And not only will you get our responses or our expertise, you also get community, right? You also get to know how people who are in the same spot as you have dealt with said things. And so I really implore you to check out the community, join the wait list. I hope that this video was helpful. If you have any questions, please drop them in the comments. If there's something that you want me to dive into more, you can drop that in the comments. Please like, subscribe, share, and I'll see you guys in the next video.